Let's talk about Bitcoin's 30-day volatility. We're definitely not over 42,000 anymore, as it says in the title, but it did break it at one point today. That was cool, at least for 420, for you fans of the 420-ness. But Bitcoin's 30-day volatility slips to a 17-month low. Market makers from DeFi option vaults are perhaps the invisible force helping create a boundary for prices. There is a clam in the Bitcoin market, the likes of which we last saw before the beginning of the late 2020 bull run. The leading cryptocurrency's 30-day volatility, which measures the standard deviation of daily returns over 4 weeks, has declined to 2.2%, the lowest since November 5th, 2020, according to data provided by Arcane Research. The gauge peaked above 6% in June 2021 and has been declining on a declining trend ever since, barring the temporary spike to 4.5% around the March Federal Reserve meeting. The steady decline could be attributed to several factors, including dominant crypto exchanges, Binance and FTX's decision to cut down leverage, declining interest in crypto-margined futures, and more recently, reduced speculative interest as evidenced by the decline in trading volumes. Data tracked by Gettr Research shows that Bitcoin and Ether's weekly trading volumes have slipped to the lowest levels since the summer of 2021. Quote, both Bitcoin and Ethereum trade volumes have declined significantly since December as investors de-risk their portfolios amid growing macro uncertainty, Gettr Research's weekly newsletter published on Monday said. Quote, the trend accelerated in early April with Bitcoin and Ethereum weekly trade volume down by over 30% to 7 billion and 5 billion respectively, relative to the end of March. While Bitcoin is down 10% on a year-to-date basis, Ethereum has lost about 15% per charting platform TradingView. There are technical factors at play too, helping bring tranquility to the Bitcoin market. Market makers who buy the out of the money call and put options auctioned by decentralized options vaults, DOVs, every Friday, hedge their bullish-bearish exposure through opposite positions in the futures and perpetual futures market. According to Prime, a digital asset fund manager, in the process, these market makers create a boundary for prices within each expiration cycle. Market makers are individuals or entities with a contractual obligation to maintain a healthy level of liquidity on an exchange. They make sure there is enough depth in the order book by offering to buy or sell an asset, futures contract, or a call or put option at any given point in time. These entities always take the opposite side of investors' trades and maintain a market neutral book by buying and selling the underlying asset as the price swings. The DOVs have grown exponentially since the second half of 2021 and now add over 100 million US dollars of notional exposure to the market each week. In other words, the sensitivity of market makers' books to directional moves is increasing. As such, their hedging activities could be helping arrest wild price swings in the market. Basically, we're seeing less volatility in cryptocurrencies, what they're saying. But, quote, holding larger open interest requires larger hedging activity. This acts as a natural price floor or ceiling for spot prices at short strikes. 2Prime said in a DOV explainer note published on April 8th, quote, by holding these options to expiration as DOVs do, the gamma of the underlying option increases, thus requiring more delta hedging from market makers, further intensifying this price floor and ceiling dynamic, end quote. Is this the calm before the storm? A prolonged period of low price turbulence often ends with a violent price action on either side. For instance, the previous low volatility regime lasted for over 2 months, from late September to early November, with the cryptocurrency trading mainly in the range of 10,000 to 13,000. The breakout happened on November 5th, with prices rallying well above the June 2019 high of 13,800. Whether history will repeat itself is anybody's guess. That said, there are signs of a big move could happen soon. Quote, the 7-day volatility has climbed above the 30-day volatility, which would suggest that the market is waking up, end quote, Arcane Research's weekly newsletter published on Tuesday. Bitcoin was the last seen at trading at $41,500, representing a 2% gain on a 24-hour basis, according to CoinDesk data. So, what do we need to know as miners, as this all comes into play, etc.? I'll bring you back to the whole Bitcoin supercycle problem, where we talk about Bitcoin's natural halving every 4 years, and typically that precedes some sort of big increase of price of Bitcoin in the rest of the cryptocurrency market, where then it continues to go up for a while, and then after a couple years it takes a big dive and then remains steady until the next halving. Have we broken out of that? It's certainly starting to feel like it when we're talking about this lower price volatility. Does that mean that we are actually going to be going up though? Or is this a signal of us just getting ready to follow that traditional supercycle and crash out? I don't know the answer to that. I don't do a lot of technical analysis. Obviously, we cover a little bit of it here just to keep you in the know of what other people are saying. But I think that overall, this is a good signal for cryptocurrency and the future of it. Because if we start getting into a less volatile market, yes, the upside's not as high, but the downside's not as low. And that means for miners, for infrastructure providers, it becomes a lot more stable. You can start planning out your moves ahead of time a lot easier. So I would almost prefer that we have this kind of low volatility setup, and that we kind of continue to break out of the traditional super cycle and remain within this range, maybe even to the next halving. And then while the profitability may be low, which we're going to talk about here because we have low profits right now, low revenue in general for mining, we still can figure out how to remain within profitability and survive this bear market as opposed to a huge crash. Now, what they're saying is that this is a signal of some large price action incoming. Hopefully that large price action incoming is not indicative of a traditional super cycle where we crash out for the next couple years until we hit the next halving, and it is a big increase. Who's to say? But these are the things that we take a look at. The other option is that they are completely wrong. There will be no price action, and we will continue to move sideways within the cryptocurrency market for a bit longer. I'd like to hear your thoughts and opinions down in the comment section below, and of course within live chat. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.